Welcome to Money RX for CRNAs. I'm your host, Brett Fellows. Picture this scenario. You've worked for decades as a CRNA. You've built a solid nest egg, and retirement day finally arrives. The celebration is over, the farewell party is done, and now you're sitting at your kitchen table with a sobering realization. That paycheck that you've depended on for 30 years, it's gone forever. Now what? Where does your money come from to pay the bills? Should you pull from your 401k, your Roth IRA, that brokerage account you've been building? Choosing the wrong account first could cost you hundreds of thousands of dollars over your retirement. Today, we're breaking down everything you need to know about building a tax-efficient, sustainable retirement withdrawal strategy that's designed specifically for the unique situation many CRNAs find themselves in. We're going to cover the 3 types of retirement accounts you need to understand, the optimal order to withdraw from each, and how to avoid the costly tax issues that catch most retirees off guard. By the end of this episode, you'll have a clear framework for turning your retirement savings into a reliable income stream that lasts. Before we talk about which accounts to pull from first, we need to start with the understanding the fundamentals. You should understand which types of income you'll have that won't impact your portfolio at all. As a CRNA, you're likely looking at a combination of Social Security benefits and potentially some pension benefits depending upon where you worked. Maybe you have rental income or other passive income streams. This is your foundation, your guaranteed income that shows up whether the stock market is up, down, or sideways. And here's why this matters. Let's say you need $10,000 a month to live comfortably in retirement. If Social Security is going to provide $4,000 of that, then you only need to generate $6,000 from your portfolio. That's your gap. And knowing this number is really important because it determines everything else about your withdrawal strategy. Another important factor to consider: the timing of when these income sources kick in. If you retire at 62 but wait until full retirement age to claim Social Security, you might have a 5 to 7 year period where you need to cover 100% of your expenses from your own portfolio. Now, this isn't necessarily bad. In fact, it can be a strategic advantage for tax planning, which we'll discuss shortly. But the key is knowing these numbers up front so you can plan accordingly. Now let's talk about the 3 types of accounts you're likely pulling from in retirement, because each one has completely different tax implications. First, you have your taxable accounts. This is your regular brokerage account, maybe a trust or joint investment account. The money you put into these accounts was already taxed when you earned it. So when you sell investments from these accounts, you'll pay capital gains taxes on any growth. But if you're strategic about it and your overall income is low enough, you might pay 0 in federal capital gains taxes. That's right, 0. Second, you have your tax-deferred accounts. This is your traditional 401k, 403b, your traditional IRA. Any account where you got a tax deduction when the money went in. Here's the catch. Every dollar you pull out is taxed as ordinary income, just like it was a paycheck. And here's the bigger catch. At age 73, the IRS starts forcing you to take required minimum distributions, whether you need the money or not. And third, you have your tax-free accounts. This is your Roth IRA, Roth 401k, money you've already paid taxes on that now grows completely tax-free. When you pull money out of these accounts in retirement, it's 100% tax-free. No taxes on the principal, no taxes on the growth, No taxes ever again. Now, conventional wisdom says you should spend down your taxable accounts first, then your tax-deferred accounts, then your tax-free accounts last. And while that's not completely wrong, it's not optimal either, especially for high-earning CRNAs who are likely to face significant required minimum distributions down the road. Here's where we get strategic with a tax-efficient framework. The optimal withdrawal order isn't about spending down accounts in a particular sequence. It's about filling up tax brackets efficiently while setting yourself up for long-term tax savings. Let me give you a practical example. Let's say you're married, both 67 years old, and you need $40,000 per year from your portfolio. You have $200,000 in a brokerage account, $400,000 in a traditional 401k, and $400,000 in Roth accounts. Here's what I would suggest. Take about $32,000 per year from your traditional 401k, just enough to fill up your standard deduction and keep you in the lowest tax bracket. Then take the remaining $8,000 from your brokerage account, targeting long-term capital gains that qualify for the 0% federal tax rate. Why this combination? Because you're paying zero taxes on the brokerage withdrawals and you're paying the lowest possible tax rate on the 401k withdrawals, all while systematically reducing the balance in your tax-deferred accounts before required minimum distributions kick in. This is completely different from the traditional approach, and here's why it works better for CRNAs. You're likely to have substantial balances in your tax-deferred accounts. If you don't start drawing from them down strategically in your 60s and early 70s, you're going to get hit with massive required minimum distributions that could push you into much higher tax brackets. And it can get even more sophisticated. If you have that taxable account, you can use it to pay the taxes on Roth conversions, allowing you to convert even more from your traditional accounts to Roth accounts. This strategy can potentially save hundreds of thousands of dollars in taxes over your lifetime. Now, everything I just described assumes you're not yet claiming Social Security. Once Social Security comes into the picture, the math changes. Social Security has its own unique tax rules. Depending upon your total income, anywhere from 0% to 85% of your Social Security benefits could be subject to federal taxes. The key is understanding something called provisional income, which includes your adjusted gross income plus half of your Social Security benefits. For a married couple, if your provisional income is under $32,000, your Social Security isn't taxed at all. Between $32,000 and $44,000, up to 50% of your benefits are taxable. And above $44,000, up to 85% of your benefits are taxable. This is why the withdrawal strategy I described earlier becomes even more important once you're claiming Social Security. You want to be very strategic about how much taxable income you're generating from your retirement accounts, because it affects not just the taxes on those withdrawals, but potentially the taxes on your Social Security benefits as well. There's also the challenge of required minimum distributions, or RMDs. Imagine you're 75 years old. You've got $800,000 in your traditional 401k because you were conservative about withdrawals your early retirement years. And now the IRS says you must withdraw about $32,000 this year. Next year, it's $34,000. The year after that, it's $36,000. And it keeps growing. You may not need that money. Between Social Security and your other income sources, you're probably comfortable already. But the IRS doesn't care. They want their taxes, and they're going to force you to create taxable income whether you want to or not. Now imagine that scenario, but instead of $800,000 in your tax-deferred accounts, you have $1.2 million because you had a great career as a CRNA and maxed out your retirement contributions. Now your RMDs are pushing $50,000 plus per year, potentially pushing you into higher tax brackets and causing more of your Social Security to be taxed. This is why the strategic withdrawal approach I described earlier is so powerful. By systematically reducing your tax-deferred account balances in your 60s and early 70s, especially during years when you're not yet claiming Social Security, you can keep your required minimum distributions at manageable levels throughout retirement. Okay, everything we've discussed also assumes normal market conditions. But what happens when the market crashes right after you retire? This is where having a bucket strategy becomes crucial. Think of your retirement portfolio as having 3 buckets. A short-term bucket with 1 to 2 years of expenses in cash or cash-like investments. A medium-term bucket with 3 to 5 years of expenses in conservative investments. And a long-term bucket with the rest in growth investments. Now, when the market is up, you can stick to the tax-efficient withdrawal strategy we just discussed. But when the market is down, you pivot to your cash bucket, letting your growth investments recover while you live off your safe money. This approach prevents you from having to sell stocks at the worst possible time, which is one of the biggest risks to retirement success. The sequence of returns in your early retirement years can make or break your entire retirement plan. The beauty of this system is that it gives you flexibility. You can be tax efficient when markets are good and defensive when markets are bad, all while maintaining the income you need to live comfortably. Let me bring this all together with a real-world example that reflects what many CRNAs face. Meet Emily, a 62-year-old CRNA who just retired. She has $250,000 in a brokerage account, $600,000 in her 401k, and $150,000 in Roth accounts. She needs $75,000 per year to live on, but she's delaying Social Security until age 67 to maximize her benefits. Using traditional withdrawal advice, Sarah would spend down her brokerage account first, then her 401k, then her Roth. But here's what would happen. First, for the first few years, she pays very little in taxes. But by the time required minimum distributions kick in at age 73, her 401k has grown to over $800,000, and she's forced to take distributions of $30,000 plus per year on top of Social Security benefits, potentially pushing her into higher tax brackets. Instead, here's what I recommend for Sarah. Take $40,000 per year from her 401k and $35,000 from her brokerage account. The 401k withdrawals keep her in low tax brackets, and she can structure the brokerage withdrawals to pay 0 in capital gains taxes. Over 10 years, this approach could save her over $150,000 in taxes while preserving more of her Roth accounts for true tax-free growth. Now, a quick note, this isn't a set it and forget it strategy. Every year, Sarah should review her tax situation, consider market conditions, and potentially do Roth conversions during low income years or when markets are down. This is exactly the kind of strategic, personalized planning that can make the difference between a comfortable retirement and a truly wealthy one. Retirement withdrawal planning is about maximizing every dollar through smart tax planning and strategic decision making. The order in which you withdraw from your accounts can literally determine whether you retire as a millionaire or a multimillionaire. It can mean the difference between leaving a legacy for your family or spending your final years worried about money. This level of planning doesn't happen by accident. It requires intentional strategy, regular review, and the kind of expertise that understands both the tax code and the unique challenges facing CRNAs. If today's episode has you thinking about your own retirement withdrawal strategy, or if you're realizing that your current approach might not be optimal, then I encourage you to take action. This isn't the kind of decision you want to leave to chance or figure out through trial and error with your life savings. For CRNAs who want more clarity, more strategy, and more confidence in their retirement planning, there's a community here that understands exactly what you're facing. To stay connected, follow along on our Instagram or YouTube pages at MoneyRx for CRNAs, where you'll find practical tips, real stories, and behind-the-scenes conversations that speak directly to the CRNA experience. Until next time, make it a great day.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.